Yeah, good afternoon, everyone. My name is Chris Robertson, Vice President of U.S. Surface Transportation and Maritime Shipping with Deutsche Bank. I'd like to thank Capital Link for another great event this year, and it's certainly a humbling ask that they've asked me today to host this panel as a relatively young analyst in this industry and joined by a panel of such distinguished and experienced leaders. So given the recent developments between two of the largest publicly traded tanker companies over the last few days, in addition to the geopolitical situation unfolding in front of us, we've seen a spike of interest and re-engagement in the crude tanker space from our clients after a seasonally weaker summer period, in addition to the production cuts by OPEC that were extended into the end of the year. So given that, my first set of questions are going to look at the industry as it stands today. So let's turn to our excellent panel today, including CEO of International Seaways, Lois Zabrocky, Dr. Nikos Tsakos, CEO of Tsakos Energy Navigation, and Robert Burke, CEO of Ridgebury Tankers. So let's take a look back before looking ahead, and let's review the last few months of where we saw what appeared to be some normal seasonal rate seasonality. So I'd like to ask your thoughts, each of you, around this year's summer period. What would be considered normal versus what might have been driven by exogenous factors?
First of all, my name is Bob Burke, and I run Ridgebury Tankers. I'd like to announce that we have achieved net zero carbon. Actually, not just net zero, but absolute zero. We're still working on scope 3, but it's a long walk for me to the office, so that's going to have to wait a bit. For those of you who don't know us, we're a private company, and we're sponsored by a variety of private equity firms. And we've sold all of our tankers, some 28 tankers in the past 18 months. We started, about this time last year, we started pretty aggressively selling tonnage, and we delivered the last ones in August. So I don't need to talk my book because I don't have one, but
we'll get to that.
It does give you clarity of purpose when you're thinking about getting back into the market. But to answer your question, over the summer, what was exogenous, what was normal? I have this theory in my head that everyone thinks what's normal is when they first entered whatever business they're in, and that sort of sticks in their head as equilibrium forever. I could be wrong, but I started in shipping in '86 when markets were horrible, so I've always felt uncomfortable when they're really, really good, which sort of pushes me to make the sell decision when things are good. I think the average rate for MRs prior to the last upturn, it was about $15,250 a day for the past 20 years or so, something like that, right, guys? Yeah. And normal's not really fair. I mean, there is no average. You can drown in an average of an inch of water. But if you take that as an average or a normal, then anything above that has to do with the dynamics of the fleet, the economy, and of course the Russian situation. So I would say at least half of that has to do with the Russian situation. Just off the top of my head.
Lois Zabrocky, and we have both evenly split, really, crude and products, 75 tankers, and I guess I would say that, if you look at the summer rates, I don't disagree with Bob in the sense that, but we do have very low worldwide inventories. We have recovered demand from COVID. And I say, like, when those lines cross, you start to have more balance in the market. And then on top of that, you have all the displacement from, the Russian production and the expansion of ton mile. And then on top of that, you just keep layering a lot of extra geopolitical tension. And all of that volatility tends to lead to higher highs in the market. Which we have seen this summer with very strong performance across really all tanker segments, from the Vs down to the MRs. The Vs actually less so. The Suez, Afras, Panamax is super strong. MR is super strong. I said it's almost the smaller your vessel, the higher your rates have been. But we do expect for that V market to come into its own, and I think the prior panel, the investors really talked a little bit about that kind of a setup.
Hard act to follow, but in 10 we're, I would say, similar. 70 ships also divided equally between products and crude. We did what Bob did early in the year. We replaced 10 of our first generation. Most of the ships, or all the ships we operate, we build them ourselves. So all our 2005, 6, and 7 MRs, or a big part of them, we sold in the early part of the year, almost at the same price as we built them about 17 or 16 years ago. So the company, it's not secret, we have in excess of $500 million in cash. So the summer, even if the market had a fluctuation, we were able to take a couple of days more extra holiday in Greece because of that market, and because of the prospects being, as you rightly said very well, the supply and demand equilibrium is the lowest in the 30 years I've been in the market. And I think that that's something very positive going forward. And we are trained in shipping to be able to adapt to geopolitical events, and there we are again. We're back to the drawing board. We had 3 crises, one after the other. After the COVID in 2020, we were hit by the Ukrainian situation, and then we have now trouble in the Middle East again.
Back to your decision to divest the fleet, you're left with 0 tankers in this market. Hindsight being 2020, was that the right decision? Do you regret the decision, and how are you currently thinking about the market?
First, I don't always agree that hindsight's 2020, but I'll take that as it may. I think it was the right decision. As the pundits like to say, it remains to be seen. Our decision was that, by our calculation, there were at least 2 really good years of revenues priced into the assets when we decided to sell. And our assets are a bit older, and we willingly take it off the table. And if someone else bought it and had 3 years of good revenues, they're going to make some good money. But given our entry point and the type of group that we are, it was time to sell. I don't regret it.
Fair. Nikos, you brought up the geopolitical issues. Let's turn to OPEC just briefly. The data seems to indicate there's a difference between rhetoric around production cuts and actual product flows in the market being drawn down from inventories. So in your opinion, what is the true impact of these cuts been so far? Should the cuts end by the end of the year? Do you think we see more of a psychological response, or is there any lingering effects that might impact the market kind of going forward if they decide to end those cuts?
I think the more we go forward, the more I think it's more psychological. So you might get a couple of weeks of charterers taming down their demand for ships, but there are so many alternative supply right now locations other than OPEC, other than the traditional OPEC countries that fill up the gap. So I mean, we see that. We see there's a 2-week slower period when people are trying to redirect their cargoes and taking a breather, but then the market comes back again because of the supply and demand situation that we're facing, also because of the increase in ton miles due to the geopolitical events. So in general, I think as citizens of this world, we would rather have make less profit and have a peaceful world where we're able to actually operate our ships freely around the world, rather than this helter-skelter situation. But being ship owners, we need to adapt in those two.
Lois, maybe turning to you, can you comment on the expanding ton mileage we've seen from the expansion in production out of the Atlantic basin that has somewhat offset the loss in OPEC production?
Yeah, to some degree, it's a little bit of the reversion to what we had kind of expected to see before, we were hit with COVID and really the Russian war, and that being that you have the reemergence or the resurgence of emerging markets and demand from non-OECD, and then more supply coming from OECD. So, it's more preponderance of increased production out of Brazil and Guyana and US Gulf and the North Sea. And the demand increases coming from, the eastern markets, which tends to set up, a stronger ton mile picture for us.
And one last question for Lois, in the geopolitical realm here, on the Russia front with production cuts on the product side, will that impact your fleet at all? What are your thoughts around there?
Well, we've seen, I think over the weekend or, by last Friday, the Russians had resumed their diesel exports or, have allowed that to come back onto the market. I think that it's very critical from what we read internally for that, for the prices not to be super strong within Russia, but they don't really have a lot of storage or a capacity internally for that diesel consumption, and so we've seen that start to come back into the market, although we have made the choice not to load Russian product because there is such demand at the moment. When that is off the market, that does impact rates across the entire fleet.
Taking a higher level view for a minute, I know that myself and many in this audience have heard over the past few years about the rosy supply side picture, but let's turn more to the demand outlook. So looking at 2024, I have 3 questions and 3 panelists, so choose amongst yourselves which one to answer here. But what needs to continue to go right? What needs to improve further from here? And what could go wrong?
Well, I think what has to continue also answers to what could be wrong. I think this is the first time in, as I said, 30 years that I've been in the business that ship owners have shown degrees of non-insanity. So they have kept away from ordering unneeded numbers of ships. It's the first time that they have shown tolerance in that, and they have kept away from over-ordering. Okay, we have examples of ship owners that cannot keep their, they keep their pence in their pockets, so they want to order ships, but we are still at a very, very low. So I think this should, if this continues, even if demand for our services reduces to more normal levels, the market will be positive for quite some time. What can go wrong would be a wave of over-ordering, which will create a difficult market condition by 2027, 2028.
I would take the, what do we need to really improve, and it is for certain just, building on what the captain said, about what do we need to go right, and there being less orders and, really less on the supply side. A derivative of that perhaps, or a piece of that is, really as owners, it is still an evolving, okay, what will be the fuel that you burn? What is the right type of engine to invest in, and we have to be ready to pivot it and try to imagine tonnage that's as future forward as possible. And I would also say, improving, we're waiting for, really this back-ended additional demand growth here, and that we are anticipating kind of coming in still in the end here of 2023. We've had very strong markets, don't get me wrong, but we're still sort of looking for some more barrels to be demanded, and, that would cause OPEC to say, okay, the demand is there, let's bring the barrels back onto the market. So what can go wrong to me, recessionary headwinds, and where are those coming from? Is it the U.S.? Is it China? Where is everybody in this process of digesting the interest rates? And I think we've had really strong demand, even in this situation where we've had high interest rates, not high maybe to the 80s, but high relative to the business cycles that I've seen.
So which one am I left with?
All of the
Whichever one you
above,
want.
your choice.
Like I said earlier, my feeling is the market's unnaturally high. So then I think when the markets are tight, obviously a little bit incremental demand can send them skyrocketing or can send them plummeting on the other end. And what's hurt us in the past is the order book, as we've all said, and that comes in fairly quickly. I don't want to say it's different this time, but I will say maybe there's a paradigm shift, which is the same thing, just sounds better. There is less shipyard capacity, and the demand for more value-added, expensive assets such as container ships to be built in the yards and gas ships, I think, is a lot higher than on the tanker side. And I think the demand for container ships will continue, not just past the COVID squeeze on transportation, but because they have more severe pressure on ESG issues than I think on the tanker side. And they're, most of those are point-to-point assets, so they can have alternative sources of fuel faster than we can solve our issues. So I think it's mostly, the order book that drives things. The demand for oil has gone up fairly consistently over the past 30, 40 years. It's 1% a year, 1.5%, and that doesn't vary significantly usually. I mean, there was a couple down drops that are temporary, but the worldwide natural demand for oil seems to be fairly consistent. So my view is, obviously, anything can happen and everything is already priced in. So I think the view has to be, will the next event drive us, into a supermarket, or are things going to normalize again? That was a pretty good non-answer.
Sure.
Okay, good.
And it may not happen in that order.
It may not happen that already.
Nikos, congratulations on the 30 years of being a listed company. And turning to your comment just now about ship owners finding some capital discipline here, do you think that's been an internal transformation, or has been discipline been instilled from the outside by providers of capital, shipyard capacity limitations, or other factors?
I think it has to do with the uncertainty of what ships to build. So I think that's the big. There's always, for large companies, financial capacity is always there, finance is always there. So I think it's more that people do not know if they're going to be building a ship that will be around for the next 10 years or it will be attractive in 10 years. So we are in the danger in the tanker segment to face what the LNG market faced 10, 15 years ago, when every time you ordered an LNG, the technology would change before you actually took delivery of your LNG. So I think it is more of fear of that than anything else. So it is a decision driven by logic, which is strange talking about ship owners, but it's true.
Sure, and let's look beyond the next few years and do talk about kind of future proofing of the fleet here. How are each of you evaluating future fuel technologies outside of just pure economics? And what are the more incremental upgrades that you're currently working on looking at?
Well, I think I mentioned right now, it reminds me of the vaccine situation with COVID. I mean, we have, we used to have Johnson & Johnson, Moderna, and Pfizer, so you have to make sure if it's going to be LNG, methanol, or biofuels or something else. So right now we are uncertain. We follow the example of what our charterers would do. So we just took delivery of 4 LNG fueled vessels with long contracts to a major oil company. We are in discussion with methanol vessels going forward, but again, I think we're not taking a chance to build something without a contract that would significantly depreciate the vessel in the 10 years.
Yeah.
Lois?
I would dovetail there, at International Seaways, we took delivery of 3 VLCCs that are dual fuel, and, that's de-risked by being on a 7-year, which is for us, quite long-term time charter with a profit share element. So I think that that project is really part of a 10 VLCC project where the cost came in very well, at $100 million for a dual fuel V, very economic financing, and that element of ability to have a return going to the upside. And then beyond that, at Seaways, we have ordered 2 LR1s in Korea for delivery second half 2025, and we did order them with conventional engines. That having been said, we really put into that project that project will have to carry a conversion on those vessels, and the vessels do have a stronger deck and bigger generators, and come with a certification to convert to LNG. On the LR1 size, we don't know if there'll be LNG in the Panama Canal bunker ready for us or not, or whether it'll be methanol, or maybe we'll have to do some kind of carbon capture and storage. So we know we'll have to fight on the biodiesel front to compete with airlines, right? Because there's more demand than there is non-food supply on biodiesel, right? So, as this evolves, we have to be prepared and ready to pivot.
Nikos said, the industry's shown discipline. I think nobody knows what to do, as you two just evidenced, unless they have a long-term charter from somebody who has a lot of pressure, an oil company, to show some progress in getting to zero. Otherwise, it's a lot of money with no apparent rationale for making decision A or decision B, which is why the order book's so low.
Sure. Speaking of capital allocation, just Lois and Nikos, what are your thoughts at this point around prudent capital allocation? What makes your approach the best?
So, I'll take a stab at that. We, at Seaways, we have been doing a 12-cent dividend every quarter and then a supplemental dividend. So, if you look at our last 12 months, we've been close to 15% on our average market cap that has been returned to shareholders. And we continue to pay down our debt. So we've been very active on both of these fronts where we've returned almost 50% of our net income to shareholders through dividends. And then as well, we have continuously improved the balance sheet, paying down debt, and the team just concluded a revolving credit facility at SOFR plus 190 the other day, which increases our ability to be ready to act when we do see opportunity in the marketplace.
Well, you're doing very well. I'm looking at my finance department there. Well, we have paid a dividend for the last 30 years, and we initially were semi-annual when we were in Oslo. Then we were actually pushed to go quarterly, but in the last 5 years we're back to semi-annual again. We have, in the 20 years that we are on the New York Stock Exchange, we had a net income of $2.6 billion in 20 years in a cyclical market. We have distributed 750 of that, which is an annualized close to 6% year in, year out. It's not, it's nothing too extravagant, but I think for a cyclical industry, it keeps us going, and TEN is one of the few companies that we have never had to restructure any of our debt, any of our finance during the crisis, because we always kept very or significantly cash balances. I've been criticized about this, but I've always been telling that the only real time that you appreciate cash is when you do not have it. And I never, as long as I'm here, I will never put the company as the guys go in this situation. So we're always keeping a little bit more cash than we need, but for good use.
Nikos, if we had a dividend aristocrat, that's the technical definition, right? Maybe you would fall into that, for the shipping category for 30 years of uninterrupted dividends.
Thank you.
Yeah, a lot of talk today has been around dividend policies and if investors are truly rewarding those who pay out higher dividends or have a more sustainable program. But let's talk a moment about valuation in general. At this point in the tanker
I just want to
cycle,
say we gave all our money back to our investors.
yes. Thank you, Rob.
Not all of it, Bob. I think you took a little piece.
But so going back, at this point in the cycle, analysts often take a NAV-based approach to look at valuation. Does that really make sense in an upcycle here? Should we be looking more about free cash conversion and generation, yield?
I have never been a believer, for a reason that I can explain without taking too much time, of the NAV situation, because all of us have a different strategy on same ships. We might have, it's like, let's say, New York real estate. You might have two identical buildings, one of them with a 10-year lease at a very positive level, and the other an empty building. You cannot give the same valuation to both. We say shipping is floating real estate. That's why I brought this example. So being a company that has 70% of our business on long-term employments, many of it, lots of it with profit share, I believe that the NAV is not a fair valuation. I think you have to look at net income, or at least the price or cash flow much more, because we are a cash flow producing companies in that respect.
Yeah, I would, our CFO, Jeff Prebor, is right there, and he would say to me that, we can't tell investors that we're right, and, we can't tell investors how to think. So I guess I would say that NAV goes down as a line of sight if you're navigating, right? It's one of your lines of sight that you put on your chart to see where you are, and I think that it's up to us to sort of push the free cash flow and, earnings, valuation further forward to get that to take hold more fully.
Since I now don't have a book to talk, when I look at the public shipping companies, and I'll invest in some here and there, I look at how much cash they have and what I think they're going to do with it. And we all know the personalities that run the public shipping companies, and if I think they're going to redeploy it in a good sense, then I'm happy with that. If I think they're going to do something silly with it, I'm not going to buy their stock, no matter what discount they're at and how much cash they have in the balance sheet. And I think classic corporate finance theory says that cash on a balance sheet, if it's too much, trades at a discount, because it's better off in the investor's pocket than in management's pocket, because otherwise they would, past a reserve, whatever you think the reserve should be. So that's my view on it, and that counts into NAV also.
You brought up personalities in the industry, Robert. Just want to hear your thoughts around, maybe broadly speaking, where the industry is today from a G standpoint in the ESG formula here. Are there any outstanding governance issues that you think still need to be addressed to attract more institutional capital into the shipping market?
Generally, most of the larger, well-capitalized companies, I think, are run very, very well. It's these sort of small spin-offs with 1, 2, 3 ships that are a disaster, and I don't think help our industry at all. They certainly don't help some of my fellow panelists with the reputation they get in the press and the major press. But I think most of the names that we all deal with are really in good shape with good leaders right now. But the smaller companies are a problem. Smaller, like 1, 2, 3 ships that are spin-offs that constantly dilute themselves. Those are the issues.
Lois or Nikos, any response to that as well?
Well, I guess I would say that as a publicly traded company, you have, I call them the report card people, ISS, Glass Lewis, and, really thought leaders out there that are saying, okay, you must have strong governance, no related party dealings. These are things that, INSW has a long legacy from OSG, so it was always publicly traded in a different way, and so that consciousness has always been there. But you're also being driven by investors, by policies being put in place to help you along your way, should you not think that it's important.
Well, I believe the industry has gone really a long way in the last at least 30 years that there were, at the time we started, perhaps a handful of publicly listed companies around the world, not only here in the US. I think we went public in '93, TK followed in '94, and I think this generation of companies have created a very significant peer group. At least on the in the tanker segment, you have a dozen companies that are in this. We call it in soccer terms the Champions League of public companies that follow, I think, the rules, do the reporting, and it's correct. And after that, it's a free world, and the shareholders can decide if they want to invest to whatever you mentioned. There's nothing that we can do to stop them. But I think the industry has moved a long way to create a good corporate structure for the larger companies.
So new building asset prices remain pretty high here, especially when you're adding on alternative fuel technologies. Financing is now more expensive with interest rates where they're at. And there seems to me to be risk in the out years due to regulations and behaviors centered around reducing carbon in general, not just in the shipping industry, but in the economy in general. You're talking about long-lived assets here, and I put to you a question: which comes first, peak oil demand or peak crude tanker fleet growth?
I think we are quite far from the peak oil tanker growth right now. So my view is that if things continue to go, but everything changes very fast, as we've seen in the last week. If things continue to go the way they have been going, I think we will see oil peak demand surpassing any supply from supply of tonnage.
From everything that, DNV and IEA and OPEC and, really looking at everybody kind of in their projections of liquids, oil demand, looks to peak somewhere around 2028, 2030, and looks like the crude fleet has already peaked, if you look at the order book and, the lack of orders therein, right?
Yeah, I think that's a great point. Just to expand further on that, if you might, Lois, so do you see ordering in the future being fleet replacement at this point and not growth?
I mean, right now, we're not at fleet replacement, so if you take the, and there have, in 2023, we've seen a lot more ordering, is what we would say, but if you look at the total tanker order book, it's 5%. So, an oil tanker either in 20 or 25 years, you should be replacing 4 to 5% per year. Not, that's the entire order book, and now we're talking into 2026, right? So that's 3 years out. So that is the least that I have seen in 30 years.
But eventually they have to correlate because the oil has to move, and that means even if they don't correlate in the short run, they have to correlate in the long run, or else ships will last longer. We had too many ships in 07, 08, 09, and then no orders for a while. There's a big recession in our industry, so they have to correlate. Given as long as the trade routes don't change and 10 miles, are actually correlated.
Trade will not stop.
Oil is going to move, so that means the ships won't get scrapped as fast. That's all.
Speaking of scrapping, Robert, so we've been thinking a lot about increasing regulation as it affects the shipping industry, but it seems to me that there'll be increasing regulation around greening of the shipbreaker industry and recycling industry. We also have several segments, including tankers, dry bulk containers, et cetera, with aging fleets. So is everyone going to be able to rush out to the scrapyard when it comes time to scrap a ship, or do you think it'll be more difficult over time?
Well, we all know the regulations are getting tighter and tighter. I've read different projections that scrap markets will be tighter in the future because again, you look at 07, 08, 09, the big bubble of ships that were built then, and they may last 20 years or 21, 22, 23 years, but they'll all be scrapped around the same time. So there could be a squeeze, especially if regulations get tighter, which they will. And no one in this room cares about regulations, or no one's afraid of regulations as long as we all know what they are and they're clear. The problem we have is when everyone doesn't follow the regulations and then they get a price advantage on us.
Yes, and I would say that, the regulations continue to intensify, right? So we know that much for sure, right? That, we had a trajectory, with IMO, and it's all, it's all laid out, and you're have your target, and then, annually that is now increasing in the way you measure it, and it will only become more and more rigorous and intense, on the tanker space. And since we were talking recycling, I do think that it's already driving change, right? Where the Hong Kong Convention has already made a substantial change in how ship recycling is actually executed on the ground.
And the scrap market doesn't drive the freight market drives the scrap market. And whether you get $300, $400, $500, $600 a ton, it makes a difference. But at the end of the day, those extra $100 a ton on the margin doesn't drive the scrap formula.
I don't think we can conduct this panel without mentioning the Frontline Euronav deal. So I'd like to get your general thoughts around, is that deal good for the industry as a whole, good for the sector? And you don't have to necessarily talk directly about your peer, but general thoughts.
I've never heard of them.
I believe that the tanker market or the shipping market is such a fragmented side of the business with so many ships. It is always good to be able to have large companies. It helps as far as operation is concerned, and it helps as far as commercial control of assets. Now, I have always been a big supporter of pools. I mean, you do not need to go out and spend billions of dollars to control and have the same result on a fleet. You could do it by actually pooling, and I think it has been done successfully in the past 100 or 150 VLs or 200 Suez Maxes to make a difference in the market. So I would rather spend more time in working in commercial discussions rather than try to pull assets together through mergers or acquisitions. But this is my view. But I believe that having bigger and commercial control on assets is positive for the tanker market.
Yeah. I mean, I would say that, I think both Euronav and Frontline, amazing powerhouse tanker companies. We've been partners with Euronav on FSO joint ventures and Tankers International for over 20 years, and have really worked together very collaboratively. To your point, Nikos, and from all appearances, the deal that struck looks to be a fair representation of where values are today.
We've done a lot of business with both of them also. I think at the end of the day, the people who have the money and own the ships seem to have gotten a deal where they both like the assets that they received and the direction that they're headed, which is a lot more peaceful than a battle for the next 5 years, which would have been a disaster for everybody.
So is further consolidation likely or no? Nikos, you mentioned the pooling. Do you think there's a lot more scope for commercial cooperation?
As I said, I'm a big supporter. However, pools are like an umbrella. People actually go under it when it rains, when things are bad, and then as soon as the market gets better, they all close the umbrella and stop pooling. I think pooling is a good thing for the industry, and it should be supported through the good days and the bad days.
As a dedicated pooler, I would simply say that, we really look to ally ourselves with, different pools where, we either have an ownership interest or we're joint venture partners, and really try to work collaboratively to get the highest TCE and really optimize. So.
And they're extremely efficient for someone like ourselves who want to do smaller fleets of ships, and we can plug and play, very, very efficiently. And the pool system has become very sophisticated, so that you really do get your correct pro rata share of revenues. I mean, it's a self-correcting mechanism. If the pool partners aren't happy, or if someone's on the short end of the stick, or a certain group of asset holders don't like the way their points are allocated, they're going to leave. So it's a real good collaboration, and the pool meetings are spirited, but generally friendly. Everyone understands that they're better off in one common marketing pool than out by themselves. It also enables financial investors like ourselves to be able to buy assets, get them into a pool right away, and then when we want to sell, we can take them out. So it gives us the liquidity to buy and sell assets without looking at a staff of thousands to support, back at home base. So we really like it.
We're running a bit short on time here, so we'll end the panel with that. Thank you very much for your time today, panelists.
Thank you.